Okay, I'm back. Just kidding. Little pandemic humor. No, I do not wear my mask at home, but I thought that would be a good pattern to interrupt. So I haven't made one of these in a while because I wanted to have a nice production. I figured it was a nice time to step it up, go to the next level, have better lighting. I want to have a better sound. So I just said, I'll just put it off until I'm ready. I was also producing some content in Spanish. That didn't quite pan out, but I'll probably get back to it at some point. But this was a bit too tempting with this whole, GME, GameStop, BlackBerry, AMC, all these stocks being shorted and being short squeezed and by retail buyers. And I wanted to make a video. I actually put a thing, and bunch of people said, a couple dozen people said, hey Gabe, you should make a video about that. Some people said, no, I don't want a video about that. But screw you if you didn't want a video. So we're gonna have a video. So to explain what happened with GameStop and what does it mean to short a stock, we have to understand what shorting is, first of all. So when it comes to a stock, you have to understand that there are two fundamental things that a stock has. A stock has a price, and a stock it goes up and down with time. Okay, maybe a third element would be volatility, but volatility is just time and price interacting in chaotic ways. That's all it is. So it really is just price and time. Okay. Now I've heard a lot of videos and a lot of pundits, talking heads on TV saying how, all kinds of things about this. This is going to be the entrepreneur's perspective, okay? This is going to be from the standpoint of somebody who creates value in the marketplace, okay? So this is not non-political, and this is, and of course there's politics to everything, but what I'm saying is, I'm not trying to be one-sided or another-sided. We're just going to talk about what it is, and if you guys want me to talk about at some point, if what could be a better way or what I think about some ways, then we can delve into that. But we have enough to talk about just talking about this. So I want to explain what shorting a stock is, then we'll explain why the short squeeze happened, why now, and maybe what the implications are for the future. Those are the three things I want to do right now. All right, so when you have a stock, let's say like GME GameStop, the ticker symbol is GME. Okay, so GME has a certain price right now, right? So that dot means right now. Okay, so right now is in the roof. It's like 300 or something. Okay, but the price was whatever it was, right? And how is the prices of stocks set? Generally, the prices of stock is set by what people think about the company. So in rough terms, if a company is well run, if a company is a good company, the stock goes up or is expensive, and if the company is experiencing troubles or not run correctly, then it goes down. It is a feedback mechanism of the marketplace, okay? So, but this is important to understand that the idea with buying stocks is not just because they're going to go up in value. Now, most people, that's what they think about, because how can you make money when a stock loses value? That's harder to understand. It's a little bit less intuitive, okay? So generally, people buy stock. I'm gonna do this with red. Generally, people buy stock, and let's say they buy it here, and if they think the stock is gonna go up, then you buy a stock. Because what you do is you buy in the here and the now, and then when it goes up, then you sell. Okay? And then this difference between the price that you bought and between the one you sold, this difference, that's money that you made. Okay? So that's what happens when you think the stock is going to go up. Okay? But what happens if you think the stock is going to go down? Is there a way to make money off of that? And their answer is yes, there is. Okay? And it's not illegal, it's not unethical, it's information of the market. Because the problem is, we don't know how much things are. Nobody knows how much anything is. So, because the calculations are too big, right? There are too many things to take into consideration of what something is worth or not worth, right? So when you have milk and you make it into cheese, is the cheese more expensive than the exact amount of the milk? And the answer is yes. Why? Because of supply and demand. So what we do in a free market or in a freer market, seems like we're not going down that path very much these days, but in a freer market or in a free market, what happens is there are many transactions and many people agree or disagree about the price. And when they agree, that we call that a transaction, right? A willful transaction where both parties get what they want. But notice this, every transaction of value, of price, is an irrational transaction. It's not rational. Because if it was rational, there would be no transactions. Why? Because the only reason you make a transaction is because you give up something that you think is worth less than what you're getting. But guess what? The other side does the same thing. They get something that they think is worth more than what they're giving up. So how could those two simultaneous things be true? Well, they can't. They're irrational, so to speak. Okay? And since we have a free market, and in a free market anybody can participate, or that's kind of the goal, then at that moment, at that instant in time where two people get together and they say, I'll give you this much. No, I want this much. Well, how about this? Well, how about, let's split the difference and let's do it. Boom. And then right there, the transaction, since it's a free market and technically most people, let's just say ideally, can participate in the transaction, we take that to mean that at that point, the whole market agrees about the price of that particular transaction. And those are the things that are taking place all the time, throughout the day, and sometimes without stop. Sometimes they do stop. For example, Bitcoin doesn't stop trading ever, right? Crypto doesn't stop trading, but the markets do. They open in the mornings and they close at night or in the afternoon, and they do that in Eastern Standard Time. For example, New York Stock Exchange, right? So this is what happens. So in other words, if you think the stock is going to go up because many people are going to want to buy it, why does the stock go up in price when people want to buy? Because when people are starting to buy more, then the guys that are selling say, well, what if I ask a little bit more for that? What if I ask a little bit more, and a little bit more, and a little bit more? And if many people want to buy, and that's how supply and demand gets evened out, okay? So the price starts to go up when people want to buy. Now, shorting means that you think the stock is going to go down, okay? So what happens here? So how can you make money with the stock going down? How does that even work? You do this by shorting. That's why I said, if you think it's going to go up, you buy. If you think it's going to go down, you short. This is not even talking about derivatives, which are like options contracts, which that's like 10 videos down the road from this one. But for now, just think about this. If you think it's going to go up, you buy. If you think it's going to go down, you short. And what is shorting? Shorting is what you do is you buy, right? You buy, but you don't buy from the market. You borrow it. Okay? You borrow stock. Okay? And then so you tell a broker, you say, tell you what. You have a bunch of GME stock, yes? And the broker says, yes, I do. Okay, how about if I borrow it? Then the broker says, well, I'm not just going to let you borrow it, for no money. He's like, no. I'm going to borrow it, and I'm going to give it back to you. The same stock, I'm going to give it back to you, and I'm going to give you a little bit of interest. Since it's just sitting there, and you can let me borrow, I'll give you some interest, and it's all good. And the broker says, that sounds like a good deal. So that's what you do. So you borrow the stock, but you don't just keep it in your back pocket. What you do is you sell it. Okay? So when you sell it at the price that it is. Why? Because you think it's going to go down. So what you do is you sell it, you borrow it, you sell it right away. Then you wait until it goes down. And then when it gets down here, you buy. So you see how it's different? It's exactly opposite. Instead of waiting and selling, as when you buy, you wait and you buy when you short. Okay? So, and what happened here? Well, you just bought stock at a lower price. Okay? So this difference right here between these two prices is money that you just made. Because you sold it at a higher and you bought it at lower. Then you return it to the broker, and you give him some interest, and then you pocket the difference. That's what it means when you short, okay? Now, you need both of these things happening at the same time because these are the things that determine the price. The people that think, yes, this is worthwhile, I'm going to go for it, this is a good bet, and then the other people that say, yes, I'm going to call that bet, right? And you always have somebody, you always need those opposing sides. So I hear some political pundits on TV from all sides saying that shorting is unethical and these people are making too much money. Short, what value are they putting into the market? Yes, they're putting a lot of value by telling us that they think that this is a bad stock, okay? So this is fundamental. So if you have a problem with shorting stock, you should also have a problem with buying stock. If you want to get rid of shorting, then we need to get rid of buying altogether, okay? So this is not unethical. Now, we can talk about why hedge fund managers make so much money. And they make a lot of money, they do. Should they make that much money? Well, they probably always will make money because they're so close to the tap, so to speak, where the money flows out. But they probably make more money than they should. And they do that not because of corruption and not because of capitalism. It's actually kind of the opposite. They make probably more money than they should because of government regulation. But that's a different, because a barrier of entry, but that's a different video, okay? So that's what buying and shorting stock means, okay? So what happened with GME? What is going on? So what happened was that there was a lot of retail investors, as opposed to institutional investors. Okay, so institutional investors are the guys you hear about. You know, these are the Blackstone, the Bridgewater, the Pershing Square, the Berkshire Hathaway. You know, those are the guys that are entrenched. You know, the guys that got names, the guys that got a lot of guys in suits and making a lot of money. Retail investors are like people like you and me. Let's say. I mean, I run a fund, but it's a small fund, so I'm still counted as a retail investor, right? A lot of people access these things with what is called discount brokers. Okay, so a discount broker is somebody that can sell you the stock at a discount, right? And meaning a discount with very low rates, very low commissions, okay? So the one that's popular these days is Robinhood. And some friends were asking me what I thought about Robinhood. Well, now they got their answer. So Robinhood. But there are many, right? There's TD Ameritrade, right? There's Charles Schwab, that's what I use. There's in most banks have, they have some kind of way of letting you invest in stocks, right? And what you can do is you log in and you buy stocks, okay? So what happened? Well, there's a series of things that are, kind of the planets are aligning, right? There's never been a better time to be in the public markets. Now, the markets were made to be that, public, for anybody to be able to invest. But the reason that most people didn't invest is because of the different barriers to entry, mostly knowledge. People don't understand. Hey, I'm in the markets almost every day, and now sometimes you don't know what's going on. And also money. You needed to invest a certain amount of money, right? So in the beginning, really, you needed to have lots of money to be able to invest in the public markets. But discount brokers made it very affordable, right? Also, I've been talking about this for about a year and a half. I even gave a couple classes for some of my friends on trading stocks because they were interested. Not that interested, but they were somewhat interested. And so I talked about this, that about a year and a half ago or a year ago, TD Ameritrade, I think it was a year and a half ago, I think it was TD Ameritrade, then they cut commissions completely, right? And they figured they could make money on the back end of customers. Well, that precipitated that all discount brokers cut all their commissions. So right now you can trade the cheapest you've ever been able to trade, right? And for example, so Robinhood, the whole business model is that they don't charge at all for commissions. They charge some fees, but very little commissions, right? So that incentivizes people to trade more because they have less to lose, right? I'll just buy the stock, and if I don't like it, I'll just return it, right? And I basically get all my money back. But in the olden times, if you wanted to buy a stock, you have to buy the stock and pay commission, And then if you wanted to sell it, you had to sell the stock and pay commission. So those two chunks of money that were taken from you, they make you think a little bit about, should I invest or not? Because I need to make sure that I make at least that much to pay commissions and then be clear, right? So discount brokers became basically free. And then, of course, the pandemic happened, right? And so COVID-19. And so a lot of people home, more people than used to. And so people were like, well, how am I going to make money? What's going on? So these things lined up together. And so these guys, the retail investors, it seems like there are other bigger players involved. It wasn't just some guys in their pajamas, playing Call of Duty or whatever. But they started to look at what the institutional investors were doing. Okay, so what they were doing is they were shorting stocks that were, for example, retail, in the retail industry. Okay, this is not to be confused with retail investors. Industry. So for example, like GameStop, like Neiman Marcus, like JCPenney, right? Because what were they thinking? Remember, they were thinking, look, these companies are here, but the pandemic and the lockdowns and everything, their stock value is going to go down. It's going to go down, right? So to make money, what we're going to do, again, I'm not saying these guys are angels either, to make money, we're going to short a lot of that stock. We're going to buy it right now, we're going to sell it, and we're going to keep that money. And when it goes down to where we think is the rock bottom, then we're going to buy the stock, return it to the broker, pocket the difference. No one's the wiser, okay? And so if you're looking at a stock like that, you think, wow, a lot of people are shorting the stock. That means a lot of people think the stock is going to go down. That's what it means, okay? So generally, you don't buy a stock that's going down because, well, it's going down. Why would you buy it, right? You short it, and that's what those guys were doing. So you don't want to short it anymore because, I think at some point they shorted as much as 140% of the shares of GameStop, which that's a different video. Why that's even a thing, okay? So they were secure that they were just gonna make a lot of money because they just shorted the stock. This thing is gonna go down. I'm gonna sell it, and it's all gonna be great, okay? Well, the retail investors are sitting there and going, well, actually, if we all pool our resources together, right? And they did this through Reddit and other social media platforms. We're going to buy a lot of that stock that these guys think is going to go down, but actually is going to go up. So here's a new graph. I'm going to make it right here. Hopefully you guys can see this. So here's the stock, right? These guys think it's going to go down. So they're waiting for it to come over here, right? Well, these guys start buying. And remember what happens when you buy? When a lot of people are buying, the stock tends to go up. Okay? And up, and up, and up. Right? At some point, it went something like, 1,600%, right? Which is crazy, right? And so you start to have this big gap in between. Okay? Now remember, these guys are thinking the stock is going to go down. And they already sold it, right? Remember, you borrow it and you sell it right away, right? And these guys are buying it, making it more and more expensive, more expensive. Now, what can you do as somebody who's shorted the stock? You can wait it out if you want, okay? But at some point, you are so heavily invested in this short that you have to consider that if you don't start buying, because the problem, you see, if time stops right here, then this is fine because you think, well, maybe it's going to go down after that. But you have no idea if this thing is going to go down or if it's going to keep going up. Maybe it's going to be twice as expensive tomorrow, or 4 times as expensive, or 16 times as expensive, right? So what happens is the guys are heavily shorted, right? They're already very invested, right? They start to panic and they start to go, wow, we're going to lose a lot of money. So we better start buying some of this stock, even if we end up buying it at the most expensive price, because we might have to buy it at even more expensive price. So that's why they decided to start buying. And what happens when the guys that were shorting, Now they have to buy. Well, it kicks up the price even higher. Okay? So this, we call this a short squeeze. So that is what's going on. Okay? Now, that means that these guys, remember, these guys, everybody, let's say, everybody, bought it at this price. But, I mean, not really, because these guys, the hedge fund guys, they bought it even lower. But then the retail guys said, no, we're going to take that back. We're going to take it up. And so these guys can start to cash out. And they'll make that difference, right? As these guys have to keep buying, and then the price keeps going up, okay? So many things can be true at once, okay? So I don't like hedge fund guys as much as any guy, right? Because I mean, but you gotta understand why not to like them. You don't like them not because they make a lot of money. That's not a good reason to like somebody. If you don't like somebody who makes a lot of money, you make a lot of money, okay? So that's called envy. You don't want to do that. Don't do that, right? So that's not the reason. The reason is that a lot of these hedge fund guys, for example, in the last crash, they took a lot of risk, and we all bailed them out, right? Again, regulation is really the problem, because when regulation happens, everything has a veneer of safety, like everything's going to be fine, but everything still blows up. So we paid for all the bureaucrats to be regulating, and then they didn't regulate. And then now we bail everybody out. So, when we say we mean the taxpayer, right? So that's probably a way. And so when some of my left-leaning friends or left-leaning media, or they talk about socialism for the rich, they're absolutely right. That should not take place. That should not happen. Nobody should be bailed out. If they crash and burn, they should be allowed to crash and burn. I don't care what happens. If you take the risk, you can take the reward, but also you can take the damage as well. Okay? So that's what we call the short squeeze. So there are several things happening here that are going to be the implications. Okay? The implications for the future. So first of all, I'm not going to draw it here. So first of all, retail buyers. Retail investors, it's their epoch, okay? It's being proven. Now, this is also kind of an interesting thing. How do you coordinate that? How did they actually stick together and buy a lot of this, right? And this wasn't a random thing. Somebody studied this. Somebody said, look how heavily shorted these guys are. We can squeeze the heck out of them, and they will squeal. And that's exactly what happened. But one thing is to study it and to understand it, and the other one is to execute it, not by one guy, right? And not by a small group, by many of them. And for many of them to say, yes, I'm going to put my money there. And things like hold the line, hold the stock were trending on Twitter and other platforms, because they were saying, keep buying, keep raising that price, okay? So the retail buyers now, retail investors now, they can influence the market. Now we know, right? And hedge fund managers know too, okay? So that's the implication number one. Implication number two, the fact that Robinhood and some of these other platforms stopped trading, it's really bad. That's probably the worst thing that happened out of this. So if you want to get mad at anybody, get mad at these platforms, because what they decided to do is, okay, so if the retail guys are making money, no, we don't like that. No. The hedge fund guys are supposed to be the guys that make money, not you guys, right? And it's like, no, okay? Now, the third thing is that, yes, you can criticize this a little bit. Why? Because the retail investors are really not... they really don't think that these companies are worth what they are spending their money on. They don't. They're just, if you play poker, the analogy is they're not even calling the bet. They're raising. And so the hedge fund guys have a pocket aces, and they're sitting there going, we're going to win. We're going to win this hand. And then the retail investors, God knows what they have, but they don't have a very good hand, and they raise, right? And the hedge fund managers say, "Oh, what? You're not supposed to do that. I'm going to win this hand." Well, and the retail investors say, "Well, if you want to see my cards, you have to call a bet." right? So now they have to start buying to make sure they cover. Because see, if this distance between the shorting and the price of the stock is big enough, it can potentially cover the whole fund. And now, once you're over it, once it covers the losses, cover all of your fund, you are done. Game over, my friends. It's over, right? So that's why they would panic, because you always want to cover. You want to be capitalized enough, right? Again, to take a metaphor from analogy from poker, you have to have a big enough stack to be able to go all in with somebody else and be able to be a match. If not, they can cover you completely and you're out of the game, or in a couple of terms you will be, okay? So this is what happens. So the reason that maybe it's a little bit of a cynical play, right? Because they weren't saying, let's buy GME, GameStop, because they're a good company. No, they were saying, let's buy GME so we can screw these guys, okay? But it's a legal play. It's legal. It's legal. Okay, so I just think it's kind of funny when the hedge fund guys do it, nobody says anything, and when somebody else does it, well, you're not supposed to do that. Okay, so again, this is all information for the market. Next time around, or anytime, I can guarantee you that there's this whatever happened right now is starting to enter into the calculations and pricing for a bunch of stocks, not just these. Okay, so these guys are going to learn from it, right? And but it was a play. Again, a little cynical, and you want to be careful with that, because again, we all derive information from the market. So when politicians say, oh well, the rich people in the stock market, no, the stock market is all of us. It's all of us. There's so many 401ks tied to the market. There are a lot of pensions and insurance tied to the market. Right? Maybe you're not spending or investing yourself in the market, but you are affected, and it is important what the market, because the market is so think about here there's down the road here there's the farmers market, the Dallas farmers market. Okay, so and I can go there anytime that I want and buy stuff, and sometimes I do. Okay, but just because I don't go one day, it doesn't mean it's a private market. Doesn't mean it's not available to me. It doesn't mean that I get to charge different prices or I get to pay different prices because, well, it's not my market. Yes, it is. It is a public market. Anybody can go in and buy whatever they need. Stocks and bonds and options, all of these things are just products on a shelf, and they move up and down in price depending on supply and demand. So how do we determine if something is worth more or less? By the many transactions and all the information that comes out of people thinking this is going to go up, so I'm going to buy, or that people think it's going to go down, so they short. So there's nothing wrong with that, of course. On top of this, then you have derivatives, which are options, which are contracts for packages of shares that you can buy, but you can buy the right to buy, or the right to call, the right to put, but not the obligation. And that's like, again, 10 videos down the road. But it's the same element. It's always price and time. What is the price and how much time does it go by? And do I think it's going to go up, or do I think it's going to go down? So the ramifications are many. We're going to see more and more retail investors. Maybe you are one of the new people who are out there in the market. And I know many of my friends, sometimes I find it kind of interesting that they say, well, what about this stock? What about that stock? And have you heard about this? And have you heard about that? As if it was a product in the farmer's market. Did you eat this? Or did you try this? Did you try this juice? Did you try this this meat over there? And so it's kind of interesting how they have, it's the same thing. It's products on a shelf. And if you're informed enough, and you understand, you can go out there and buy some stuff and kind of get familiarized. So we're gonna see a lot more of that. Also, it was gonna be interesting, because what happens, and this is you'll hear this a lot now. There might be some regulation that takes place, okay? And the regulation is always in the name of safety. We want people to be careful, because to be completely fair, there's an element to it. Why? Because see, the price is going up because the retail investors are buying and because the short sellers are also buying to cover their positions. But at some point, this becomes a game of musical chairs, and somebody's going to end up without a seat, and a lot of people are going to end up holding the bag. Now, what we want, and it's not about, we're rooting for the underdog, right? What we want is for the hedge fund guys to be stuck holding the bag, but we don't know. So, for me, I think the markets are buyer beware. You are on your own risk. You do whatever you want. I have some people who ask me, well, Gabe, what do you think about day trading? Day trading means that you trade every day something. You have transactions as opposed to trading and holding for weeks or months or years, okay? And there are many people who make money day trading. There's nothing wrong with day trading, right? But that's a little bit more of like a little bit of a game, right? Where you're trying to pick up fractions of differences, okay? Now, the politicians will say something like, the stock market is not a casino, or shouldn't be treated as a casino, okay? That is all politicians speak for. We're going to have regulation, and the regulation is meant to protect you, okay? That's what they'll say, to protect the consumer, to protect the retail investor. That's what they always say, okay? But what really happens is that the institutionalized investors, they are the ones that now have a bigger barrier to entry, and they can make even more money because it's harder to get to that level, because you have to cut through a bunch of red tape. Okay, so that's the other ramification, and you don't want to be fooled by that, right? We don't want to support any regulation. We want people to be able to trade. As a matter of fact, I fully support some kind of hearing or some kind of investigation on why Robinhood stopped trading these stocks, right? Let people trade. Keep your hands off of the market, people, okay? This is the public market. This is the farmer's market. You go in there and you buy anything you want. I shouldn't be required to show my bank statement before I show up at the farmer's market to see if I really can afford what I'm going to buy. No, it's up to me. It's my money. I decide what to do with it. Well, what if I have to pay rent in a couple of days? Oh, well, I can just spend it all in the farmer's market if I want. Okay, so the same thing is true. And again, this is what it means to be part of a free market, part of something that you are participating in willingly, because you either think it's going to go up or it's going to go down, because you want to participate with your knowledge, with your research, and you contribute to the economy, you contribute to the market, you contribute value by putting that information into the market, because you're not just an analyst, an advisor, kind of sitting in some chair somewhere. You are putting your money where your mouth is, so that's value to the market. And if you're right, the market will reward you. And if you're wrong, as with our friends, the hedge fund managers, they were maybe technically right? But they were wrong in that somebody else wasn't going to come and shake them up a little bit. Again, I don't necessarily agree with that, because what we want is we want a trustworthy market, right? But if you're shorting the heck out of it, you better be ready to have your bet not only called but raised, and now you gotta match it, because if not, you might just lose that turn. You might lose your whole pot. You might lose your whole stack that way. So this has been a fun video. I'll probably, again, not gonna make too many of these, because I want to have a completely different setup and a nicer everything, nicer audio, nicer lights, nicer view, nicer sound. So I'll probably do that, but I wanted to record this one talking about what it means to short. Again, what does it mean to short? To think that it's going to go down and make money by doing it, right? Why the GME happened? Because now more people than ever are involved in discount brokers like Robinhood, and then COVID-19, bunch of people home, bunch of people sitting around saying, how am I going to make money, right? And then number three, what are some of the ramifications? Where you're going to see a lot more retail investing, which is great. We want more of that. The more people that are involved in the public markets, the better. I prefer if it's not in a cynical way, just to thumb their noses at the hedge fund managers. But hey, again, these are big boys. These are big boys. Again, they always keep saying that they're so smart, and hey, there you go. There's your chance to prove it, right? So sometimes people play dirty in poker. Sometimes people bluff. sometimes people don't have the best hand, and they're trying to win. So you gotta call it if you got it right. And then also we can expect regulation, which we should oppose, because it's going to just increase the barrier to entry. And then the guys that are making money will be making even more money, probably unjustifiably, just because they're the guys that are there and can navigate all the red tape. And the guys that want to get in won't be able to get in with the idea of the government trying to protect them, protect us, and they should do that. Get out of the way, let the free markets live, and see more fun and funny, super funny things like this. Probably the funniest thing I've ever seen in the stock market, and really in my lifetime. So really cool stuff. We'll see you guys next time.